Inflation comes up with the bond market because bond investors want to make more than inflation on their bonds. So if inflation is running at 4% and bonds are only paying 3%, you're essentially losing money to inflation, right? So if people are nervous about inflation or think inflation is going to go up, that can help to drive the bond rates higher because people want to be fairly compensated for holding these debt instruments. Inflation now is a little bit different than post-COVID, right? We're in a different environment. Rates are already relatively high at the Fed, but if we see inflation go up due to tariffs or other policy moves by the Trump administration, that's going to make it tough for the Fed to lower rates. What investors don't want to see in general is the Fed raise rates even more. The signal from the bond market is partially what unsettled investors and why we saw it in the stock market.
So the current tax bill that is on the table is potentially concerning in general for the economy. In the bond market, especially since any bill, there's going to be spending involved in issuing debt. But the sheer amount of debt that's potentially going to be issued by this bill, it's a lot. And that could help ease some of the demand of these treasuries, but also it can have a negative effect by like the perception of why is the government spending more money than they have. So how do you balance those two things?
I think when that first draft of the bill came out, it did spook bond investors saying, okay, is the United States going to never address this debt issue? A lot of projections were that it was going to increase the national debt significantly.